Welcome, everybody. This is the introductory session of the Futuristic Tax Planning Community. This is designed for sole proprietors, tax professionals that can be enrolled agents, CPAs, what have you. It's probably for one or two business owners, maybe three at the most. That's probably not so much for staff people because it's really a change of your business philosophy in some ways. But the nice thing is it can be done gradually. It's not something that you have to flip a switch and everything's going to be totally different. I think you'll see that there's ways that you can come in at your own pace. You can do it with one or two clients. You can get comfortable with it. You can turn up the speed. You can offer more services and more levels, but all of that's down the road for most people that would want to consider this. What I'm trying to address is the problems that we've seen in the tax profession. I mean, everybody knows what they are: compressed workload, tax deadlines, problem clients. They never get you the stuff on time. They're late. They're price sensitive. Sometimes it's even combative. It's very stressful. Everybody's facing the same kind of complications. The tax code is complicated. Reconciliation with the rules in your state. All of this causes confusion and angst. And there's fewer students coming into accounting. The baby boomers are retiring. So it's a stressful profession, and there's all kinds of problems there. There's potential solutions that are flying around. Mine is one of them. So I appreciate you taking the time to kick the tires on this. I think this is going to be a little bit easier than some of the ones that you see out there. Raising rates. Everybody says to raise the rates and fire clients, and that's ideal. That's wonderful. Work less time, get paid the same or more. And that's an end result that we're looking for here. But to get there, all of the suggestions that I've seen are a little bit complicated. They're hard to chew. You can do cost segregation studies. You can do tax forecasting. You can do spinoffs and mergers and acquisitions. All of this stuff requires additional skills in a lot of cases. It could be a lot more work, and you wonder how you're going to squeeze that in with the other work that you have. You can throw terms around like advisory services, tax planning, things like that. They're really not that well defined. It's up to your own imagination, and you have to figure out which clients get it, which ones don't, which ones will pay for it, how to sell it, all of that stuff. So these are all the challenges that we face in trying to get out of the rut, if you will, of where we are in tax prep. And I say we because I came from tax preparation. I do not do taxes. I don't sell anything anymore. I want you to know from the outset, I'm trying to do this to help you. And I know all the different levels, all the way from preparing my first tax return to selling financial products and big insurance policies and assets under management, all that stuff. I've done it, and I'm through with doing that. I've retired from that, dealing directly with clients. I'm not selling anything. So I want you to know that I want to teach you and help you get comfortable where you are and where you could be, and help you to whatever level you want. So that's a little bit about my background. I am a CPA and a CFP and a CLU, Chartered Life Underwriter. In the insurance field, that's the top credential pretty much. And I'm a PFS with the American Institute of CPAs. I did 6 years in public accounting, some audit, some tax work, all of the above for a small firm. And then I fell in love with financial planning, and I pursued my certified financial planner designation. And I left the CPA world because you really couldn't sell products. You couldn't talk about products in the CPA environment back in those days. And you can today a little bit more, but I left the public accounting world and I went into the product side to try to understand how the different products worked and stuff. And that was quite a challenge. But after years and years of doing it and butting heads with some people and learning all that I could, I came to be a respected advisor because I didn't fix what wasn't broken. I always looked to do the best product, regardless of what company produced it. I love the strategies and I love to help people. And I felt like I was doing a great thing by keeping them from making mistakes. And that's a big selling point, I think, for what I'm offering you. And that is that your clients are making mistakes all the time. They're getting ripped off. 80% or more of the people that I had to compete with and learn with and teach and all of that, they're not that great. They're selling products. They're using sales pitches. They don't know if the products are great. They don't tell you the bad things about them. So there's a lot of things that can go wrong out there, and our clients can really suffer from that. And they do suffer from that, and we know they do. We hear about the mistakes all the time. So I think if you can do my version of tax planning, I think you'll be really doing a great service for your clients. So they'll be happy when they feel that, when they know that, they're going to be happier with the higher fees that you're going to want to charge them. So the whole goal is to get clients to be happy, to pay you more, maybe get rid of the problem clients and the ones that make you work the long hours. If you have fewer clients and you can 2x or 3x or 4x the revenues from them, I think everybody's going to be happy, and you're going to save them from mistakes and bad advice and bad products. So that's the goal here. In this first session, I want to just kind of clarify things like that and how the service works and what I've done to create some tools that will help you get there. So having talked about the challenges and the problems of coming up with something, I wanted to give you an idea of what this service that I call Futuristic Tax Planning is all about. America's national debt is dangerously high right now, and I'll explain that. This will lead to higher future tax rates than we have today. And that's not on the books now, and it's not something we're normally dealing with. In 2026, we know rates go back to pre-2018, but that's a small change compared to what we might have to face. And we can do things like Roth conversions and other tax-free income sources that'll help when rates go up. And we should be doing that. But the two advisors that might talk to you about this are your tax professional and probably your investment advisor. Now, my audience is going to be tax professionals here. And you know that we're not talking about that for a number of reasons. One, it's tough enough to deal with today's rules the way they are and today's rates and getting all the numbers where they need to be. And we're probably not recommending Roth conversions, which is the starting point for creating tax-free income. We probably don't recommend that to as many of our clients as we'd like to because we're too busy and because we want their tax bill to be as low as possible. So why tell them to convert $100,000 and fork over 30 or 40,000 more to the government? So we're in a tough spot to do it as tax professionals. And investment advisors don't want to do it either because if they told you to convert $100,000, they don't know exactly what tax implication that's going to have. They're not tax experts and they don't want to be. And they're going to lose whatever the tax is. They're going to lose that from their assets under management. And that's how they get paid. So they've got their excuses for not doing it. And they love those excuses because it keeps them from losing assets under management. So most of America doesn't realize that they should be doing things like Roth conversions and using today's lower tax rates because the future rates are likely to be higher. And I'm going to get into proving that to you here in a few minutes. So that's the premise, which is important for where we're going. So what I did was I put together a number of videos that were geared for clients of yours, for taxpayers, to explain the problems and to explain, how you create tax-free revenue sources, especially people that are going to be retired in the next 10 or 20 years. If you have a Roth IRA with $1 million in it versus a traditional IRA with $1 million in it, you know that you're going to be better off, especially if rates go up. If rates don't go up at all, it's basically a wash, right? You can pay the tax now or pay it later. You'll still end up with the same dollars if you're in exactly the same tax bracket. But if I'm right, and a lot of other experts that are talking about it now are right, then we're going to see higher tax rates in the future, and it makes sense to do the conversions at today's rates versus the rates in the future. Now you'll say, or you'll feel, or you'll think that, well, if my income stops, I'm going to be in a lower tax bracket anyway in the future. So it may not work for people in the 37% tax bracket or 35, although I do have clients that are still doing Roth conversions and stuff at that tax bracket because they think it's going to be worse than that later. But you do definitely want to take advantage of the 22 and 24%, what I call the sweet spot, because then it jumps from, instead of a 2% jump from 22 to 24, it goes up 8 percentage points to 32. So you want to take that sweet spot. And a lot of people file their taxes in that sweet spot, and they should have done conversions at least up to the top of the 24. So let's take a look at why I'm saying that. But first, I put together these videos that explain the problem. I made 16 5-minute videos, 4 on 4 different topics. So you kind of go through debt 101, 201, 301, and 401, then taxes 101, 201, 301, and 401, and Roth, and so forth. And I put an introductory video on it and a case study at the end, which was a real life client case study where I changed the names. All told, it comes out to be about a 90-minute presentation. I've sold it on Udemy to the public. It's gotten 4.75 stars out of 5. It's a good course, but it's not a huge money maker. What I wanted it to do, and what I still wanted to do, is to educate your clients and open a door for a conversation to talk about futuristic tax planning versus current tax planning and tax preparation. So I'm going to have you look at a video or two, one of the 5-minute things. I'll speed it up a little because it won't teach you a whole lot that's new. Maybe the one on debt will, but you'll see what the purpose of these things is, to try to draw the attention, open the conversation, and have a client come back to you and say, wow, I had no idea, and nobody's been talking about this. What do we do? How can you help me? And then you can sit down and you can map out a plan to do the planning and make these changes along the way. So we'll take a look at that in a few minutes. By the way, I sell the course for like $89. It could be a $500 course or $2,000 or, free. I don't really care, actually. I want it to be used by tax professionals to get this thing going. But we have options. You can charge clients to take it. We could split the cost. It could all go to me. It could all go to you. I don't really care if we kind of work out something that works for everybody. So we'll see that in a few minutes too. Let's watch a video or two real quick, and I'll I'll show you what these look like, and you can see if it's something that makes sense to you and can ease the pain of getting something started with a client. So take a minute and watch one of the 5-minute segments of this course. I'll go ahead and speed this up, so don't think I'm yelling at you, but we're going to go through it kind of quickly because I think you'll be able to follow it. This debt one is going to throw some stuff out there that I want you to really pay close attention to. So be ready for some numbers. Here's the US debt clock. You can reach it by going to usdebtclock.org on the internet. And you can see constantly changing and updated estimates for the US national debt, which, as this course was recorded, had recently exceeded $28 trillion, as well as all kinds of other information on here, including the GDP, or gross domestic product, of the United States. The GDP is usually compared to the national debt in order to determine if we have a serious problem or not. Many economists feel like the debt should be somewhere in the range of 40 to 70% of GDP, and it's clearly now well over 100% of GDP. It's actually more like 130% and rising every year. This $3.2 trillion deficit figure is how much the debt balance will grow this year alone. Now, that bothers us a lot, but perhaps even more alarming is that we see down here this huge number of unfunded liabilities of over $150 trillion that's not even included in that debt figure. These are things like Medicare benefits, Social Security, food stamps, housing assistance, and school lunch programs, and so on. The biggest liabilities are for Medicare, Medicaid, and Social Security benefits owed to Americans who are now 65 or older. And guess what? On average, 10,000 Americans turn 65 every single day. Unfunded liabilities are real dollars. That's money that's going to have to be spent. It's going to have to be funded, but it's not yet, and is not even included in the U.S. national debt. We're the only developed country in the world that does not include unfunded liabilities on our balance sheet as real debt. Now, let's take a look at this chart that depicts the national debt as a percentage of GDP. At the time of World War II, we ran up the largest debt we had ever had as a nation. For the first time, the debt exceeded 100% of GDP, and we reached over 120%. We immediately raised income tax rates for the next 40 years and paid the debt down to less than 40%. Then, under President Reagan, supply-siders convinced him that we could lower tax rates and still do very well because the lower rates would result in better economic activity, and more activity would mean more revenues and taxes and so forth. And lowering tax rates would ultimately not create deficits. In reality, it did. The debt started climbing again under both Reagan and the first President Bush. It came down briefly under President Clinton, went up again under Bush 2, Obama, Trump, and it's still climbing under President Biden. Now the national debt is at over 130% of GDP, much worse than 120% of the past. Let's take a closer look at just one of those unfunded liabilities, Social Security. Social Security was established in 1935. There were 42 workers paying into Social Security for every one that was collecting. How old did you have to be to draw on it? Back in 1935, you had to be 65 years old. But your life expectancy at the time was just 62. And if you made it to 65 and started collecting, you were expected to live only 2 more years. So 42 people paying in for every one collecting, you had to wait to 65, life expectancy was just 62, and you would collect for just 2 years on average. It sounded like it was pretty fiscally sound, right? Today, how many workers are contributing for everyone that's collecting? 3 to 1. In 10 years, that number is expected to be 2 to 1. What's the earliest age you can start taking Social Security? That's 62. And what's your life expectancy today if you are 62? How long would you expect to collect? That would be 23 years. Social Security is bankrupt. America is bankrupt. And we're ignoring the problem, letting it get worse year after year after year. Join us for Debt 301. So that's one of the sessions that we put out there in the course that'll get your clients thinking and wanting to talk more about it. Hope that makes sense. I'm going to show you one other one, if I can. All right, here we go. I'm going to be flying through this too. This is Taxes 101, and stay tuned. Here's a chart we use in several courses. We had the highest debt relative to gross domestic product in U.S. history at the end of World War II. But then for 40 years, we reduced the debt. And then for the last 35 years, we've increased the debt, again, to where it's now worse than the previous high watermark. 2 other things worth noting about the end of World War II. First, the government raised tax rates across the board in order to pay down the enormous debt balance. We'll compare today's tax rates to those after the end of World War II in a few minutes. Secondly, between 1946 and 1964, the baby boomers came to planet Earth. More people were born in that 18-year period than any other in American history. And for 40 years, Americans paid pretty high taxes. Then with the Reagan administration, we lowered tax rates. So tax rates go down here in 1986, and they stay pretty low for the next 35 years. Then beginning in 2011, baby boomers begin turning 65 at the rate of 10,000 individuals per day. And they go on Social Security and Medicare. That pace will continue through 2029. We're on an unsustainable path with all of these baby boomers looking for entitlements and the tax rates being the lowest we'll probably see for the rest of our lifetimes. You may wonder about the reality of taxes being low today. Are they really low on everyone or just the rich? And what about inflation? I don't know what I would have been making in 1945 or 65 or 85. So what does it mean to me? Well, what we did was created a calculator, a tax time machine, if you will. You can find a link to this calculator on our website and at the end of this video. But what this calculator allows us to do is look at our income here today and compare it to what that income would have been adjusted for inflation in 1985, 75, 65, 55, and 45, as well as what we would have paid in today's dollars in taxes in those years. Now, a couple making $50,000 would be at a marginal tax rate of 12%, meaning the next dollar that they would make would be taxed at 12% federal, and then whatever state tax rate they would have. The effective tax rate means that some of their income is taxed at 10% and some is taxed at 12. It averages out to 11. So the effective rate is simply the total taxes divided by the total taxable income. Now look at the total taxes here. $5,600 versus $6,000 in 1985, $9,000 here, $8,000 here, $10,000 here, and almost $12,000 here. In every prior period, adjusting for inflation, this couple making $50,000 today would have paid much more in taxes than they will today. And they would have been in higher marginal tax brackets. So any new income coming in would be taxed at much higher rates. In fact, at almost twice as much in 3 out of these 5 years elected. Let's look at somebody making, let's say, $200,000. This couple would be in a 24% marginal tax bracket today. The last dollars are taxed at 24%, and the effective rate is 18% or $36,000. They would have paid $58,000 here, $61,000 here, 47, 53, 66. In all of those prior decades, when Americans were reducing the debt, they would have paid much more in taxes, and their marginal tax bracket would be from anywhere from 32% to as high as 48%. Now let's take somebody making a great deal of money, say $2 million. They would reach the highest tax bracket we have today, which is only 37%. But if that was adjusted for inflation and it was in these other years, it would have been at a marginal bracket of 50%, 70%, 89%, even 92%. Why is marginal tax rate important? Let's take a look. The marginal tax rate is important because it's the rate you would pay on your 1099 income from savings in a taxable account. It's the rate you pay on your required minimum distributions, whether you need to spend them or not. Up to 85% of your Social Security could be taxed at the marginal rate. Rental property income, withdrawals from traditional retirement plans and IRAs. And it's the rate your heirs would pay on inherited retirement plans that haven't been taxed yet. Let's drill down a little bit on these income topics in Taxes 201. So here we have a couple of examples of what I'm trying to do with taxpayers to open the conversation with them that we're in a pickle right now and we need to be talking about it. So your best clients, every client really, you want to say we've got problems coming and we've been here before. You can see that in my video, the debt was $28 trillion. It's actually now $35 trillion and it goes up by $1 million about every 40 seconds. And that $35 trillion is debt that we owe like on a credit card. We've already spent that money. And we did that so much for the last 20 or 30 years because interest rates were so low and it really didn't bother us all that much. But the interest rates are now going up and that's going to make it a bigger problem. The 4 biggest expenditures of our national budget are Social Security, Medicare, Medicaid, defense, and then the interest on the debt. And the interest on the debt, we just passed the Defense Department budget. So it's now the 3rd biggest expenditure and we don't get anything by paying that. We just preserve our credit rating. We're paying on money we borrowed and spent in the past, and we still haven't gotten around to all those unfunded liabilities. And we all know as CPAs or EAs or whatever, as numbers people, if you're not balancing the budget, you're in trouble. It can't go on forever. And there's only 2 things you can do, raise the revenues or decrease the expenses or some combination. But back when we raised the rates like we did after World War II, all the baby boomers were being born and they were starting to go into or eventually would go into the workforce and help pay for Social Security and so forth. Now they're all retiring and there's not enough people paying into the system to pay for them. Social Security Trust Fund will run dry in about 2035. That's the latest estimate. In 2036, Medicare will run dry. And the baby boomers are not going to let that happen. They're not going to let you cut it in order to prevent it from happening. So congressmen and all of Washington, D.C. is just kicking the can down the road. They can't get reelected if they say we're going to cut those expenditures. They just keep saying print more money until I'm ready to retire. So it's a big problem, and we really need to start thinking about it. That's why I call it futuristic tax planning. I don't think tax planning is defer your income into next year, accelerate your expenses into this year, maybe cost segregation study for your rental properties. Those are all cool, but there's a train wreck coming, and we really should be talking about that. So that's where I want to be. And so what I want to do next is show you this little tool that I put together that would allow me to see what other assets they have that I can't pick up off of tax return. So you have a lot of information on the tax return, but when you want to do some tax planning, some futuristic tax planning, what you want to do is take their assets in 3 different buckets: taxable, tax deferred, and tax advantaged. And you want to move over a period of time at those 22 and 24% tax brackets. You might want to move assets into this 3rd bucket. So you just send this form out to them and they put in the amounts that they think they have in checking, savings, brokerage accounts, and inheritance might fall over here. Tax deferred, what they got in their 401ks, 403bs, IRAs, and so forth that hasn't been taxed yet, whether they're contributing anything to it, whether it gets matched. It'll give you an idea of how big this thing is going to be down the road. And then what they have in Roth accounts now, HSAs, even cash value life insurance, things that can be tapped later on without taxes. So this is a starting point. It's really not all that difficult to get the conversation going and for you to be a trusted advisor for them as to what next and where these things should be headed. I also added a couple of relevant notes down here. So this is a pro forma thing. I sell it for like $20 to clients. Again, that's something you could give them for free, or we could work out anything that works for everybody involved. But ages, years to retirement, household income, what's taxable, what their spending needs are, whether they have pensions, whether they'll both get Social Security, Roth options at work, room to the 32% tax bracket is kind of important, whether they have insurance in place already. So these are just things that I use to come up with ideas worth talking about and maybe making some recommendations. Now, as you move through this program and as you get more and more comfortable with it, you decide how far you want to go with that before just turning it over to somebody else. But I can also vet advisors that can work with you where you know that I know what they're doing, I know they're qualified. You can work with them and make yourself kind of the quarterback of the planning. The tax advisor needs to be in control because these are bigger problems than, how much the life insurance costs and whether it's term or permanent. Long-term care insurance, there's 100 different ways you could do that, or you might not do it at all. But these are all things that are important, but they're not going to be as big an expense over the lifetime as taxes are going to be. So I think the tax advisor should take control of the situation. They should pay for it. They should be on the same side of the table when somebody's recommending something and just be a sounding board and ask more questions and be convinced that it's true and it makes sense from a tax standpoint, and do more teamwork with advisors, good advisors, keep away from the bad advisors. So that's all part of what I'm trying to offer here. So this is a piece of the pie. Let me pull up something here that'll go through real quick. I put this out on LinkedIn at one time. Basically, it's from tax prep to tax planning in 3 steps to become a superhero for your clients. We know that every taxpayer is interested in ways to make more money, make it more rewarding, make work easier. There's no shortage of ideas. Here's what I think is a simple way to start at tax planning to tax prep, and people will really flock to it, I think. And I've seen it happen. So we want to gather a little bit more information, additional items for planning. I just showed you how that works. Here's one that's filled out for a client, 3 buckets, little notes down here. We can see where their money is, and we can kind of come up with ideas, brainstorm them almost as to how we're going to reduce things in these first 2 buckets and get them into the third one using smart tax planning for the current low tax rates. You can even use AI to come up with ideas. I've used that just saying, what kind of things would you recommend if we assume that future tax rates are going to be higher? And you get some ideas, you kick them around, you discard them, you tweak them, but it's not financial planning. It's moving in the direction of financial planning, but legally it's not. And you're not giving legal advice either. The goal is to start tax conversations that are appropriate and otherwise might never happen except by somebody selling something. So I think it's a win-win situation here. You should collaborate and outsource with other people as you gain your own knowledge and experience. And I guarantee you this will be entertaining, fun, if you will, because you're adding value and you'll learn a great deal from other people. And you'll learn a great deal as you go through. You'll become more valuable every time you work on a case like this. As I said, it's not financial planning. You want to kind of keep it simple and move forward at your own pace. Start out with 1 client or your top 5 clients, gauge their acceptance, let them watch the videos, sit down and talk with them, say, would you do this if it costs $200 a month? I'm going to be working with you all the way through. And I think you'll find that people are going to be happy to do it. Keys to success, enjoy the ride. It's not rocket science. It's not that hard. It's very rewarding. And I'm offering it as one of the levels that I do this with. I'm offering it 2 to 5 times a month. I will go over cases with you. You got a case, you want to talk about it, you say, this is what I'm thinking. I'll give you some other ideas. I'll endorse it. I'll tell you why it wouldn't work, blah, blah, blah. So, you'll have me to lean back on for things like that. And will this work? I've done it myself. I added them my CFP and several other credentials. I took it all the way to, selling products and all that stuff. But most people aren't going to ever get that far. They just want to add some value, get a higher per client revenue, get rid of some clients that don't care about this stuff and they're just problem clients. And you can be working less and being paid more. And you can help clients not get hurt. I've also done it with other firms. I've added 6 figures per partner in annual incomes to small firms by collaborating and coaching on this. Develop some of these tools that are going to make it easier without costing you time. It's all at your own pace, extremely rewarding to know that you're protecting your clients from mistakes. And if you think about it, the 1040 is ultimately a common denominator. Every taxpayer knows what it says, what it does. They don't know how to file one themselves or minimize their taxes, but they get it. They know where it is. They know what they're paying in taxes. So if you add a little bit of a balance sheet to it, net worth statement, now we're talking and we've got more information and it's a game changer. We can do some stuff. It's probably the easiest venue for breaking away from tax prep horror show as it is now. And you're protecting clients and increasing revenues, actually enjoying the work. So I hope that makes sense too. The last thing I want to kick around here is my offerings for helping people to proceed on this journey. First of all, I break it down into you got to crawl before you can walk, before you can run, and before you can fly. So these are all more complicated levels. And if you just start out crawling, we can work out a deal for my Secret Tax Saving Ideas course. Maybe we offer it to your clients for 50% and I get the revenues, or we offer it at the regular price and you get half the revenues, or we offer it for free and we work out how much that you pay me for coaching along the way. As this grows, there will be more and more in the training library. TFT is for tax-free tutors. That's my DBA for this service, tax-free tutors to teach you how to grow your tax-free income sources. So anything that we develop in the library, and there are things already in there now, and there'll be case studies as we go through this, you'll have access to all of that. The 3 buckets pro forma fact sheet, we can sell that to clients. We could give it to them for free, whatever. There'll be recorded case reviews that I offer. I'll record them for people that are at these other levels where I actually do the case reviews with them, and we'll record them and make them available to people who are just getting started, and recorded monthly mastermind sessions as well. In the masterminds, we'll talk about all kinds of things with other tax professionals in the group and what they're running into, what they're realizing, success stories, failures, and all of that stuff. So those will become more and more valuable as we get a bigger group and more time under our belts. Also, in the next category, we will facilitate outsourcing to financial advisors. You can do this with existing advisors that you already know, that you refer business to, that refer business to you. That's all fine and good. If you need any help at all to have that facilitated, I can introduce you to the people that are going to be good, and I understand how they do business. I'll look over their shoulder. I'll be a sounding board to you whenever they make a recommendation you think might be questionable or whatever. So I can help facilitate that in this level. We take it up from there and we add live reviews where you'll be working with me, or as we grow, other tax-free tutors on my team, and they'll do the live reviews with you to talk about specific cases and bounce the ideas around with you. And then out here in the highest level, we talk about adding licensing and revenue sharing. Now, some firms are to the point now where they manage assets or they get paid by the wealth manager who's managing those assets that they referred. So they get licensed so that they can share in revenues that the advisors are making. You can do that on the insurance side as well. Like I said, it's a complicated area that most people will never go to, but I can help facilitate that. And in the cases that I referenced where I added 6 figures per partner to a 2-partner firm, that's what we did. We got them the right licenses. They didn't do any of the work, but they ended up making 200,000 or more a year by sharing revenues with those people. So this is kind of an eyeball of it. I know it's a lot of stuff I'm throwing out there, but in this first session, I wanted to go over these different things so that you understand why I think this makes sense and compare it to some of your other options. Again, I think we're at a time right now where the nation's debt is really, really out of shape. David Walker, former Controller General of the United States under both Obama and George W. Bush, he was the controller of the whole United States. He has said repeatedly, and he put it on the financial statements every year that he presented to Congress, this is an unsustainable path. We've got to do something about it. They're kicking the can down the road. Nobody's doing anything about it. You can't keep printing money like we are. The more money in circulation, the more inflation heats up. And when inflation heats up, interest rates heat up. When interest rates heat up, all the debt that we borrowed has to be paid at a higher interest rate. It's a terrible mess that we're in, and we're not doing enough about it. So I think as advisors, it makes a lot of sense. I've tried to make it easy for you to start the conversations with clients and offer them bits and pieces of getting their lives in a better order for down the road. I'm not saying evade taxes. I'm saying pay your taxes under your own terms. You know what the tax rates are today. Let's max out that 22 and 24. In some cases, you got high income earners. There are always going to be high income earners. Even when they're not earning an income, they'll have high income to pay taxes on. Even those people can be paying taxes at 32, 35, 37% today and be happy that they're protected from a 50% or 70% or 92% tax bracket down the road, like we had in the past. We got 10,000 baby boomers retiring every day, and they're not going to be happy about cutting their benefits. And the trust funds are going to run out of money. If you sit back and look at what you're doing for your tax clients, is it enough? Could you use this information to say, I can help you save over the rest of your lifetime. I can save you $3 million in future taxes. And in my case study in the course, I showed that with a real life couple where the projections show that they'll be $3 or $4 million ahead by creating tax-free income sources. This is a powerful tool to use, and it's simple enough that you don't have to be an expert on cost segregation. You don't have to be an expert on these other areas. I hope you see that this is useful and that you're willing to come back for the next session and the sessions after that, where we'll dig into different cases. So thank you for your time. I look forward to seeing you at the next one. Do me a favor, if you like this, tell somebody. Tell everybody that you're connected with on LinkedIn. Tell people that this is worth checking out. I hope to see you back at the next session, and I'll be sending a recording out soon.